David Booth, a founder of Dimensional Fund Advisors in 1981, is the firm's executive chairman. He has served on the Investment Company Institute's Board of Governors and the ICI's Executive Committee. The University of Chicago Booth School of Business was named in his honor, and David also serves as a lifetime member of the school's advisory council. David Booth Kansas Memorial Stadium at the University of Kansas was also named in his honor. David funded the Booth Family Hall of Athletics in Allen Fieldhouse at Kansas University and donated James Naismith's original 13 Rules of Basketball. David received his MBA from the University of Chicago in 1971. He also holds an MS and a BA from the University of Kansas.
So I was at a recent conference, and Ken French was presenting on the 5-factor model now.
Right.
So they've expanded from
Right.
those 3 to add profitability and investment. Right. Let's talk about those a little bit. And I don't know if you can talk about it, but where you see Dimensional possibly incorporating those in future, evolutions of this original indexing idea.
Yeah, sometimes I feel like if I'm Rip Van Winkle, I wake up 40 years from now and look back and find out, like Baskin Robinson, now has 26 factors or something.
Right.
Research into risk and return will never be completed, partly because risk can mean different things to different people. I mean, so there isn't one unique risk.
Right.
And that's a lot of what you do is help people think what's appropriate for them.
Yeah.
And it can vary across individuals. Well, so let me just comment on value. That there are 2 basic reasons that low-price stocks have higher average returns than high-price stocks.
Okay.
There are 2 explanations. One of them is the market got it right, and the other one is the market got it wrong.
All right.
Okay. If markets are mispriced,
Yes.
then if you buy lower price stocks, you probably will do better than if you buy, because error terms, you would want to buy, if you're trying to buy the error term, you'd want to buy lower price. You wouldn't buy higher price.
Okay.
So that's one explanation.
That probably went over most of our listeners'
Okay, let me do a
heads,
little
but
slower.
the error
Okay,
term there.
yeah.
But that's okay.
So I mean, if you have mistakes, if I tell you that markets makes mistakes in pricing,
Right.
then you'd probably say, well, just give me the lower half of price. Because if there's a mistake, if these are mistakes,
I'd
they're
rather
selling
have it
too,
on the low
I'll
price.
get the ones that are selling at too low price.
Yes.
Rather than buying those that are selling at too high a price. That's an argument. That's not our argument, but that's. But I'm bringing it up in that the second explanation is the market has it right, that stocks are selling at low prices for good reasons.
Okay.
They're riskier somehow.
Right.
And if without going into the research, it's reasonable to think of these lower priced to book as being riskier. If you look at characteristics like earnings growth, future earnings growth, that sort of thing.
Sure.
These look like riskier companies.
So profitability.
Yeah.
Can we just talk about this 4th factor now about profitability and a little history on that?
It's we often say that we have, I don't know, a couple thousand finance professors around the world working for us. They just don't know it yet.
Yes.
Because if they come up with something that's really valuable and for our clients, we'll incorporate it.
Yeah.
And about 3 or 4 years ago, Robert Novi Marks at University of Rochester did a great paper on looking at profitability of firms. It's an adjusted, without getting into it, but it's a measure of profitability.
But this is like a gross profit, correct? It's not a net profit.
It's not net profit. It's taken away some of the funny accounting.
How about accounting creativity, maybe
right.
a little bit below gross profit?
And found that higher profitable firms, higher firms on this measure of profitability, have higher returns than those with the low, which is a breakthrough. Because I only chuckled because the field of accounting, you would think accountants would like to see that balance sheets mean something.
Right.
In terms of, you'd like to think there's a connection between balance sheets and stock returns.
Okay.
Well, people have been trying to torture the balance sheets forever, and it's very not very helpful. Well, here's a measure of profitability, You know, that's
Yeah.
so that's kind of cool.
Okay.
But let me talk about, as we go into you know, and we can talk more about profitability. But going from, let's say, 1 to 3 factors was huge.
Yeah.
Adding a 4th is helpful, but it's
There's smaller
yeah. I mean,
increments,
it's,
right? Yeah.
it's diminishing, like
Diminishing
most
returns.
economic effects, diminishing marginal utility or benefit.
Okay.
So, but it's worth fighting for. I mean, why not?
Yeah.
Why ignore it?
Yeah.
But it's
10,
not like
10, 15 basis points, no promises here, but all of those add up.
all those add up.
When you have fees, especially in
Right.
indexing today, you know,
Right.
somewhere in that ballpark. And if you can get a little extra benefit through the additional risk factors, you should go for them if you don't
Right.
have a cost that's
Yeah.
too onerous.
Yeah, I think that's all these things.
Yeah.
That's a way of characterizing. I think if we cover our fees and add a little bit
Yeah.
by doing applying this research, then
Right.
everybody benefits. You know.
Okay, so then the last one had something to do with the
investment.
firm, how much the firm invests
Yeah.
back in their business.
Yeah, it
and
turns
what
out-
did we discover there?
Well,
or they
the
discovered?
companies that have to reinvest a lot are probably not. They don't. Their stock returns aren't as good as those that
They
don't have
haven't
to.
been as good, right?
Yeah.
I always like to talk in the past tense.
Yeah.
We don't know what's going to happen, but
Yeah.
that's
right.
what it is.